What if the safest place you can put your money is actually the most dangerous? History doesn't repeat itself, but it sure does rhyme. Back in 1923, regular German families bought war bonds, completely sure they were protecting their future. By the end of the year, those bonds paid out exactly as promised. The problem? The currency had collapsed so badly that 1 trillion marks couldn't buy a single loaf of bread. Fast forward to 2001. Argentine teachers saved smartly in US dollars. They followed all the rules. Then they woke up to frozen accounts, a forced conversion to pesos, and a 66% wipeout of everything they'd built. And in 2008, nurses in Zimbabwe watched their life savings turn into numbers on a screen that couldn't buy a cup of coffee, thanks to inflation hitting 89 sextillion%. None of these people were reckless. They were careful. They played it safe. But they trusted the wrong definition of safe.
Welcome to WealthForge. Today we're talking about something that rarely gets enough attention: the wealth trap. It's that quiet illusion that certain investments are bulletproof just because they're labeled conservative, government-backed, or guaranteed. But when a monetary system goes through a structural reset, paper promises don't save you. They anchor you. In this video, I'm going to walk you through the 5 specific assets that consistently fail cautious savers when currencies shift. I'll show you exactly how the trap works, using real historical examples. Then, I'll share the 3 actual principles that have preserved wealth through these exact moments. This isn't about fear-mongering. It's about seeing the pattern before it repeats. Let's get into it. First up, long-term government bonds. These are usually the first thing financial advisors point to when they talk about safety. You lend money to the government, you get fixed interest, you sleep well at night. But here's the catch. A bond is just a promise written in a specific currency. If that currency loses its purchasing power, your fixed payments buy less and less over time. And when it matures, you get your principal back, in paper that might not stretch as far as it used to. Look at Weimar Germany again. Bondholders got every single mark they were owed. They just couldn't trade those marks for basic necessities. The risk isn't that the government defaults. The risk is that they pay you back in full, with money that's quietly lost its value. Second, cash savings, CDs, and money market accounts. These are the holy grail of personal finance advice. Emergency funds, high-yield savings, CD ladders, they're praised for being stable. But stability in a system that's actively printing more money is an illusion. When a government creates more currency than the economy actually produces, every dollar in your account gets diluted. In extreme cases, like Zimbabwe, it happens overnight. But even in modern economies, it happens slowly. Official inflation numbers rarely capture the real cost of housing, groceries, or healthcare. So your account balance stays exactly the same, but what that money can actually do for you quietly shrinks year after year. You're not losing dollars, you're losing purchasing power. Fourth, large bank deposits above the insurance limit. Most people know about deposit insurance, like the FDIC covering up to $250,000 in the US. But those limits exist for a reason. Banks don't keep all your money sitting in a vault. They lend it out. When a financial system gets stressed, accessible cash becomes the easiest tool for stabilization. We saw this in Cyprus in 2013. The government implemented a bail-in, taking nearly half of the deposits over 100,000 euros to plug a national deficit. In Lebanon in 2019, dollar accounts were frozen, and people were forced to withdraw in heavily devalued local currency. The moment your savings cross that insured threshold, you're no longer a protected customer. You're an unsecured creditor. And in a crisis, unsecured creditors take the haircut. Fifth, and maybe the most important, entirely paper-based portfolios. This isn't about one specific product. It's a structural blind spot. If 100% of your wealth lives as digital balances, bond certificates, or fiat promises inside a single country's financial system, you have zero friction against a systemic reset. When a currency hits its breaking point, governments don't come after your physical assets first. They restrict the movement of paper money, impose capital controls, and force conversions. The system stabilizes itself by consuming the liquidity trapped inside it. A paper-only portfolio is the easiest to freeze, the easiest to devalue, and the easiest to rewrite with a single policy change. Fifth, and maybe the most important, entirely paper-based portfolios. This isn't about one specific product. It's a structural blind spot. If 100% of your wealth lives as digital balances, bond certificates, or fiat promises inside a single country's financial system, you have zero friction against a systemic reset. When a currency hits its breaking point, governments don't come after your physical assets first. They restrict the movement of paper money, impose capital controls, and force conversions. The system stabilizes itself by consuming the liquidity trapped inside it. A paper-only portfolio is the easiest to freeze, the easiest to devalue, and the easiest to rewrite with a single policy change. So, if these safe assets are actually traps during a reset, what actually works? We don't have to guess. History shows a clear pattern. People who navigated currency shifts without losing their wealth shared three specific habits. First, they held assets with intrinsic value, things that function outside the monetary system. Agricultural land, productive real estate, tangible commodities, or businesses that actually make or distribute essential goods. These don't care about central bank balance sheets. They're valued in food, shelter, energy, and labor. When paper loses its footing, hard assets keep producing value. Second, they practiced systemic diversification. And I don't just mean spreading money across different stocks. I mean spreading it across different jurisdictions, currencies, and legal frameworks. During Argentina's crisis, the people who preserved their wealth didn't keep everything in local banks. They held accounts in neighboring countries or stable offshore systems. You can't hedge against a single system by staying completely locked inside it. Third, they used moderate, fixed-rate debt strategically. I know that sounds backwards, but when a currency devalues, your liabilities shrink in real terms, while your physical assets hold their value or adjust upward. If you have a fixed mortgage on income-producing property, inflation and monetary expansion actually work in your favor. The bank gets paid back in cheaper currency, while your assets' real-world utility and cash flow adjust to the new reality. Debt stops being a burden and becomes a hedge when it's fixed, manageable, and tied to something that actually produces. Currency resets almost never happen with sirens. They're slow floods. They arrive through policy shifts, steady money printing, capital controls, and gradual purchasing power erosion that most people only notice in hindsight. The point of this video isn't to make you panic. It's to make you prepared. Look at your own portfolio. Stress test your safe assets against monetary debasement. Build bridges to tangible value. Diversify beyond a single system. And never confuse nominal safety with real security. If you want a deeper walkthrough on how to structure a multi-currency saving strategy or how to evaluate hard assets for long-term resilience, subscribe to WealthForge. Drop a comment below and tell me which of these 5 traps you're currently holding, and I'll put together a follow-up guide with exact steps to adjust your setup. Quick but important reminder. This content is strictly for educational purposes. It's not financial, tax, or legal advice. Always work with licensed professionals before making major portfolio changes. Past monetary behavior doesn't predict the future, and all macroeconomic shifts carry real risk. Thanks for watching.
build deliberately, protect intelligently. I'll see you in the next one.